Well, greetings, everybody. It's Close of Business Tuesday, and we're really excited about today's guests. We've got Mac McFarland and Francisco Leon from CRC. I don't want to steal their thunder, but what you're going to hear from them is some really interesting new initiatives they have around their low carbon activities, and there's a lot in there. And so let me just say, Mac and Francisco, we're really pleased to have you guys and delighted to hear about some of your new initiatives. So welcome.
Thank you.
Thanks, Mayor.
All right. Well, while Mac and Francisco are getting ready and stretching so that they can take us on a tour of low carbon California, why don't we start with you, Mike Bradley? What's going on the screen? How's the world today?
Yeah, thanks, Maynard. Look, I mean, things are pretty mixed bag today, and the one area of strength that we're seeing right now is UK and European natural gas prices are really spiking again. I mean, European prices are the equivalent of $32 an MCF right now in Europe versus $5.25 in the US. We're also seeing coal prices move, and we're also seeing the European carbon credit is hit an all-time high of $68 today. So this is just leading to a resurgence of electricity generation that we saw a couple months ago. And one of the reasons why is the natural gas is around 74% full in Europe, where typically it's around 90%. And so that's what's going on in Europe. What's going on in oil? Oil really is kind of just bouncing around here. It really has no direction. And I think the reason why is traders are really looking to see what the Biden administration might do from an SPR release or any other lever, be it crude export ban, stuff of that nature, before they start to make some bets. And so that's where we are in that situation. And so, they're trying to get MoGas prices down, and we'll have to hear in the next, couple weeks if they decide to let the market, do its work, or if they decide to intervene, which probably would be short-term negative, but probably a long-term positive for crude oil and energy prices. The second thing I'd want to say is just kind of a summing up of what happened at the COP26 conference that just concluded on Sunday. The way I label this is, if a tree falls in the forest and no one's around to hear it, does it actually make a sound? That's kind of how I label the COP26 conference, because a lot of high hopes, nothing really came out of there. The big area that they really wanted to get some wording on is the phase out of coal, and what they finally agreed on, it was a phase down of coal, and that was because India and China really pushed back, so that was a huge disappointment. So, if you look at Boris Johnson, he labeled the conference as, proving the doubters and the cynics wrong. That's a massive stretch. This was really a know-nothing type of conference. Developing nations really did what they should do, right? When prices are spiking and going to the moon and their citizens are eating the costs, they back off, and that's exactly what happens. And maybe COP27 is a better environment. Well, right now, nations are going to do what's in their best interest and not in the world's best interest. So that's how we can sum it up.
Yeah, Mike, I guess we shouldn't be shocked when politicians do a little marketing, but I wonder if they had taken the entire cost of everybody going to Glasgow and all the security and the planes and the hotels and all that expense, that you probably could have donated one nuclear plant to India and skip the conference. Maybe that would have been a good choice. You never know. Okay, enough's enough. Colin Fenton, what are you thinking, my friend?
Well, adding on to what Mike was just talking about, last week we also got a US CPI number, as you probably know, on Wednesday, and a PPI number on Tuesday. And these were really important numbers because they have now totally buried the nonsense that inflation is transitory. I mean, even the central bankers can't say it with a straight face anymore. So I've got a couple of charts to show you. But, if you doubt that, just as a heuristic, think about this for a second. In the minutes following the BLS release of that data for CPI on Wednesday, November 10th, Bitcoin made an all-time high. And Bitcoin is not rising because there are backed up container ships at the port of Long Beach. It is literally an idea inside of a computer that is fabricated with a set of algorithmic rules. And so that should be your clear crystal proof that there is some kind of avalanche of money that's just sloshing around the system. And so let's look at a couple of charts just to give you a visual on it. When you look at this chart here on the vertical axis, you have the US CPI rate. On the x-axis, you have the Fed funds effective rate. And here you have every monthly CPI number since July of 1954. If you do the math, that is 808 monthly observations over more than 67 years. We've color-coded a couple of the periods. You can see that the 1966 to 1982 famous period of strong inflation, flat equity markets is here in the orange. You can see the more recent experiments with monetary policy are in the sort of turquoise blue, the more navy blue, and then finally green, and then all others are in yellow. So here are a couple of takeaways. The first is, in general, we see a pretty strong linear relationship between the Fed funds effective rate and US CPI. In other words, the Fed does its job of trying to contain price instability. At times, the Fed has fallen asleep at the switch. We've gotten periods like the 66-82 period, but then a Paul Volcker comes in and squashes inflation. As we've gone into the zero interest rate regime, we have seen a negative CPI number in July of 2009. That's this observation at -2% and a 16 basis point Fed funds. And this is where we are today. And what was so important about the data that came out in the past week is when we were down here in the 3 to 4% range, you could still, try to squiggle around and make an argument that there was some sort of extraordinary reason because of COVID or some other reason why the Fed's policy was justified here at the zero bound. Now that we have 6.2% year over year inflation with October 20, which does not even really have a base effect, one would have to explain how long we're going to allow the observations to tread up here on the zero line to higher and higher levels instead of increasing the Fed funds rate to something like what we've seen in the past. And to put a fine point on it, since 1954, across those 67 years, inflation has been above 6% only 13% of the time. And the Fed funds effective rate in responding to that condition has averaged 10% in a range of 4.7 to 19.1. So what does it all mean in plain English? If you're running a real company, if you're a CEO who has to worry about cash flow and employees and material costs, you're about to see interest rates spike from here toward here. Now, whether a market imposes it or the Federal Reserve belatedly imposes it, there is a big gap that has got to be resolved. And if it happens very swiftly, it could be very painful. Now, one might argue that 6% could come back down below the 6% line. That's certainly possible. And when we look at prior periods of 6%, there have been other reasons why they have sort of spiked up for periods of time and come back sharply. But the bond volatility that would also be associated with any kind of motion here is important to keep in mind. Another way to think about it, this is an academic kind of approach, but we give it to you because it's how the central bankers think. They have an equation called the Taylor rule. And basically the punchline here is if you're running a central bank and you're familiar with what this rule says you're supposed to do, they give us as the economics textbook, where you're at today, a 0% Fed funds target is well below where the rule says you should be. In fact, depending on what you assume for forward inflation, the number is somewhere between 300 and 350 basis points too low. This is why you are seeing Bill Dudley, now at Princeton, former president of the New York Fed, publish op-eds in Bloomberg, why you're seeing Larry Summers, President Clinton's Treasury Secretary, warning about inflation. All these people who have sort of dipped into the private sector know that we are in a really dangerous spot right now. One other point on the previous slide, I forgot to mention that we have a 0.08% Fed funds rate today. When we had this negative 2% CPI, we had a Fed funds rate twice as high. So think about that for a second. And then to wrap up with just a couple of points on gas, as Mike said, we've been showing these charts to clients to explain what's been happening in European gas and power as the pull on global energy markets. We've shown this chart before on COBT, European natural gas and storage. As Mike said, we're in the mid 70s instead of the mid 90s percentage of total storage capacity. The system still has to maintain fairly high prices in order to forestall the possibility of a stock out, although worryingly, we are still on that path. And if you look at these two charts here at the bottom, let me blow them up. US natural gas exports have been pulled to capacity limits in order to try to relieve some of the stresses in Europe. We've seen US LNG exports hit capacity constraints at 10.4 BCF a day, and we've seen the pipeline exports at around 9 BCF per day. Notice that prices got to between $5 and $6 to push the gas through that channel toward Europe. It didn't need to be the $25 to $30 to $40 that Mike was mentioning on the supply side. However, on the demand side, if you were running a business in Germany or continental Europe, and you decided that you would try to pass on some of this higher gas price to your aluminum customers, fertilizer customers, and so on, well, the system would not have that, because the point is we needed to ration away some of this demand. So here on the horizontal axis, you can see the price of UK gas, vertical axis, the commodity price for aluminum, here in the dark blue, and in the light blue, the spot ammonia price to represent the fertilizer market. And the punchline here is we had to go discover what price was required to make the smelter blink and begin to stop using gas in their operations. And the answer was, in the first week of October, about $41 per MMBTU for the smelters and about $37 per MMBTU for the fertilizer companies. Now, this has two knock-on effects. It does relieve some of the pressure on the gas side, so gas prices can start to go more sideways. But then it passes the inflationary impulse into these other markets, because by definition, they are not producing as much as they were before, and we still have demand. It gives us in the United States a recent peak in natural gas almost 6 weeks ago. I think people have kind of gotten used to the idea there's a bull market here. Remember, most folks, especially institutional investors, just would not conceive of a $5 price as recently as 6 months ago. Now that we've been here, people have got kind of bulled up. And we would just caution that even though the price in the December contract has gotten back above $5, we're starting to see some breakdown here now that price is doing its job. And so the final slide is to point out that just in the past 2 weeks, we have seen the options assessed probability in the forward curves really begin to get a little bit more nervous about the forward outlook. For example, if we look at the April 22 contract, we now see that we have a 78% probability of a price below 5. And when we look across the 625 and 650 upsides, you're seeing those numbers come down, particularly in the very front of the curve. Notably, however, the market feels pretty comfortable with the idea that 375 is still a major anchor for U.S. gas. And so, Maynard and Mike, we've been watching Washington discuss European gas and power prices and knock-on effects to the U.S. and should we ban exports and all the rest of it. The market is doing its job. It's getting the job done. We are adjusting supply, pulling in supply as necessary, curbing demand. And the worst possible thing we could do is try to, come marching into this market and try to fix things that are much more efficiently fixed by price itself. Back to you, Maynard.
That was awesome, Colin. I think there was so much in there. I'm definitely going to take away that we've been at inflation of 6% or higher, 13% of the time on that chart. It seems like the thing the world ought to do, particularly Washington, is signal to the rest of the world, we're going to get under control up here.
Yeah, it reminds me of, we first really started talking about this with the Bitcoin show in May of 2020. And then remember Admiral McRaven, we talked about the potato chips. And we pointed out at the time, we knew it was whimsical. And we knew, what the heck does this have to do with energy? But you start watching each of those prices and it becomes broader and broader and broader. And so now we're in gasoline and home heating fuels. And boy, does it suddenly grab your attention in a way that if you weren't paying attention bit by bit as it dominoed through all of those prices, it would catch you off guard.
Other than like downtown real estate in various cities, I'm trying hard to think of what isn't up a lot in this world. But we'll, for another time. Thank you, Colin, and thank you, Mike. That was a great lead in. Well, let me go back to where I started. We're really excited to have Francisco Leon and Mac McFarland today. And we're also joined by Craig Webster, our sort of roving ESG bandit, I guess is what I'm going to call you today, Craig. But we're always on the lookout for, as oil and gas and classic energy is transitioning, changing, transforming, adding, improving. We always want to highlight for all of you where we see some really interesting things happening. And Francisco and Mac, I don't want to steal your thunder, but you guys do have a lot of really cool things going on. So why don't we turn it over to you, Francisco, just to kick it off and talk a little bit about some of the things you guys have been doing at CRC.
Sounds great, Maynard. And so just to start with our base business, the oil and gas assets, CRC is it's entirely in California. We have conventional assets. So we do primary, we do water flood, we do a little bit of steam flood, but it's only about 10%, 10 to 12% of the entire BOEs as compared to the rest of the oil and gas producers in the state of California. So our assets are very low decline. They have a low capital intensity. And we produce 100,000 BOEs per day throughout the state. About 60% of that is oil. And the rest of it is NGLs and natural gas. We have premium pricing. Our oil benchmarks against Brent prices, really strong realizations. We get a premium from gas, premium for NGLs, and a premium for power. So this all translates into a company that can generate a lot of cash flow. The cash flow projected for 2021, it's about $485 million of free cash flow at the midpoint of the guidance that we put in the market. So it's a very stable, very strong foundation that comes from oil and gas. The state, as we talked about, California is an energy island. There's no direct pipeline access from the lower 48 into California. So either we produce it in the state or we have to import from different countries around the world. So, we're very proud of everything our team is doing. We're pretty proud of the assets that we put together, and the base business performs exceedingly well in years like 2021, when you have now a very low leverage in our capital structure and strong prices. So that's a little bit of an overview about California oil and gas, Maynard.
No, look, that's great. I guess you tell us the history of Francisco, but it seems like over the last 3, 4, 5 months, you guys have started talking about some of your ideas with CO2, talking about your efforts, broadly to have a low carbon, reduced emissions, et cetera. You want to nose into that a little bit for us, and, what the strategic discussion was, and then, what are the few steps you've taken so far?
Yeah, no, absolutely. I think it starts, I'll start first with the oil component to this. We have, CRC produces a very low carbon intensity oil. There's a group called the Clean Air Task Force that did a study of about 100 E&P producers throughout the U.S., and they ranked CRC as having the lowest CI out of the entire peer group. So our baseline is already a good starting point towards a lower carbon intensity, and that's ultimately aligns with very well with the state of California. The state of California wants to lower emissions. Go ahead.
Well, Francisco, I was thinking that sounds really interesting. Craig is probably familiar with that study, but I'm not sure I am, and maybe our listeners aren't. Do you mind just telling us again about that study, just so we can all probably take a look?
Yeah, the information is public. It's a group called the Clean Air Task Force. It's an independent study. We did not participate directly. They got information from public sources, and they wanted to see the profile of the oil and gas company in the U.S. in terms of where they were ranked from a carbon intensity. And so that report came out over the summer, and we talked to them after the fact to check some of the assumptions that they made, but ultimately it's an independent study that puts CRT at the top of the list in terms of low CI.
Well, awesome. Mac, you guys over recent months and quarters have been thinking about a low carbon strategy. You've been doing a number of things, and the company is getting some attention. I don't want to. I'm trying to steal your thunder again, Mac. I got to stop.
Yeah, that's okay, Maynard. You can tell the story for us if you want. So look, we have been doing a number of things on the ESG front. First, we have been working on what we call Carbon TerraVault. We've identified up to 1 billion tons of storage capability across our asset base, primarily coming from depleted oil fields. And in addition to that, at the end of the second quarter, it's been a 6-month journey, 9-month journey, but it's built on a lot of ESG progress that was made from CRC. But building on that progress over the last 6 months, what we did is we filed for a permit for an area we call A1, A2 at Elk Hills. We filed for another permit at 26R. Both of those for Class 6 storage permits. That'll give us a 40 million metric ton storage tank at Elk Hills. In addition to that, we've been advancing our behind the meter and front of the meter solar, using some of our asset positions to either use solar for the production of hydrocarbons or solar on the grid. And we can talk about that. We actually think that we're contributing in our land and our opportunities and interconnection agreements for the California ISO. And then culminating with then at the end of this third quarter earnings announcement, we just announced a full scope 2045 net zero goal. And that means scope 1, scope 2, and scope 3 full emissions reductions. And we think that based off of the unique assets that we have, our already strong methane reduction program, combined with other projects like our CalCapture, which is capturing the carbon off of our power plant and using for EOR, when you combine those, we get to a fairly we have a good line of sight to being able to offset all the way through our scope 3 emissions. So we've been in the process and on this journey, revamped this journey in the last 6 months, and really have started to define what I'll call, we have the core E&P business, but now we have a carbon management segment or business that we're trying to advance, the combination of which will give us 2045 full scope net zero.
Wow. Okay. There was a lot in there, and this is so fascinating. I guess one thing you said, Mac, and I know Mac, you've got an interesting background, a lot of power experience, a lot of energy experience. Francisco, you've been with CRC for a while, so a lot of the history. I guess the first thing that jumped out is you don't just do this like in a few months. You guys have been. There's been a lot of planning, a lot of work done over the years to think about the potential. So that was the first thing that jumped out. This is not hey, wouldn't it be nice to make some promises? This has been a multi-year effort, if I can say it that way. But Francisco, what would you add? You've seen the company in California for many years now.
Yeah, no, absolutely. I think the foundation is something that we've been working on for many years. And there's a desire to, as we operate in California, it's a desire to align ourselves to the success of California. And we have the assets and the people that are dedicated to making a difference. So a lot of these steps, we started when we separated from Oxy about 7 years ago. And it's been advancing the ball forward in terms of all these steps around lowering emissions, for example. So we took on very little flaring. In fact, we don't do any flaring, any routine flaring anymore. So that puts us in a trajectory that's far ahead of the rest of the basins in the U.S. because we've taken steps around water recycling and about just being a good steward of the environment as we lead the energy transition from an oil and gas perspective. So that's the background. In 2021 is really when we've taken the next step forward into carbon management. But there's a lot in terms of the trajectory of this company around ESG.
Well,
yeah, and Maynard, Maynard, one of the things that allowed us, if you will, to sort of leapfrog or pull this forward very quickly, what looks like very quickly, it's not. To Francisco's point, there was the CalCapture project, which again was capturing CO2 off of a combined cycle and using it for EOR, all within the fence line of Elk Hills. That's our CalCapture project. So we had been working on that, studying, learning, the ins and outs of how to make that happen, going through a feed study, front-end engineering design of that system. So building upon that, we've actually been able to leverage that into carbon storage and carbon management using our fields to attract other sources of CO2 and permanently sequester them or store them in our fields. The other thing that I think is very important for those that don't do business in California, California is different than other places, obviously regulatorily, but with that comes LCFS, the low carbon fuel standard, which is associated with the production of transportation fuels. There are credits available if you can reduce your carbon intensity and therefore reduce either your demand for LCFS or create a supply of LCFS. And that market trades $170 to $200 a ton. So when you put that on top of 45Q, and we've all seen the changes that are going through with respect to 45Q, when you have the able to put those two things together, we actually think we can do economic capture and sequestration projects. And so it's a combination of our unique assets, our unique understanding of the subsurface and the work that we've done on CalCapture, along with a regulatory scheme in California. And I'll just add one last thing, which is when we say 2045 full scope net zero, that does align, as Francisco says, or said, with the California ambitions. Now, they have a 40% reduction by 2030 already into CARB's model, into the LCFS program. But there was a bill, AB 1395, that was run this year that did not make it into legislation. That was to put a 2045 net zero goal. We think that's coming in California, and we want to be part of the energy transition. We're not saying that we're not going to produce oil and gas, but we have the ability to reduce our Scope 3 emissions from our production through our carbon management practice.
Yeah, it's as you guys talk about it, we all understand that California can be a hard place for any business to operate. But as you point out, Mac, you're taking like the LCFS program, and that's a big benefit for you. And then you're aligning the company with what the state is trying to do. So I'm hoping that you're going to tell us the state is cheering for you and sees what you're doing, and you feel a little swell of popularity. But I'm trying to temper my enthusiasm. I mean, what's happening in the state as you make some of these announcements and go in this direction? Are you turning some heads?
I think we're changing the dynamics of the conversation, Maynard. Instead of saying no to the energy transition, we're participating in the energy transition. And so when we file, for example, our Class 6 permit, whether it be we had discussions with a number of state regulators, with the EPA Region 9, because they govern Class 6 injection permits. We had conversations with politicians, with local regulators, and they've all been fairly positive received. A different dynamic than oil and gas having conversations with the California Air Resources Board. And so that's been positive. Now, you got to build credibility over time. You can't change those dynamics, and people want to see that you're real about this. And quite frankly, that's why we took the steps of filing the permits that will give us that 40 million metric ton tank we call Carbon TerraVault 1 to make things tangible for real. And since that we've done that, it has started to change the dynamics, but it's going to take longer. It's going to take proof of concept and proof that we're committed to the energy transition, which we are. And that's why we took it one step further with the net zero 2045 goal. But in addition to that, since we announced our permit application with our second quarter earnings announcements, we've started to see a influx of calls for the two sources of C, as I call them, carbon and capital. And Francisco, maybe you want to pick up on that, but I mean, we're starting to see a lot of people who are interested in doing this. So, we kind of did I don't want to call it field of dreams, because we definitely believe that there was a demand for it, but build the tank and they will come. And we've definitely seen that happen. And I think it was someone needed to take the first step and put the sweat equity into, permitting a carbon storage tank, so that then people could look at deploying capital for capturing the carbon from industrial sources. So I don't know if Francisco, you want to pick up on that.
Can I just ask, because Francisco,
Yeah.
we got to get you in here on the 2Cs, but can I just ask you on those 2 permits, those 2 tanks, how long does it take roughly to get those approved, and who has to approve those?
Well, there's a lot of agency approval. 2 of the specific ones are EPA Region 9 out of San Francisco, because the EPA has governance on Class 6, as well as permits through Kern County, because we're in Kern County there, in Bakersfield. But there's a number of analyses that have to go through, and then we have to qualify for 45Q. We have to establish the LCFS pathway. Those are certifications of those. There's a number of things. But if you looked at the long lead time item, it has been the Class 6 permit. The last one that was done took 6 years through the EPA. Right now, we're operating under a 2-year or inside construct, because the EPA is being very constructive in trying to meet that timeline that they've laid out of 2 years. And could it be shortened? I don't know, but there's a lot of momentum behind carbon sequestration, particularly by the administration and all that's going on in Washington. And so people are really trying to cut that down and get it inside of 2 years. And then by the time you look at adding the sources and the capture system, we're now working on the next evolution of Carbon TerraVault. For those 2, you called it 2 tanks. Technically it is. We call them one project at Carbon TerraVault 1. It's 40 million tons, and we can do about 1 million tons a year for 40 years in there. And so, but anyway, Francisco,
that's awesome. Yeah, hit us with those 2Cs, Francisco.
Yeah, so in terms of capital, what we've seen as we rolled out our strategy in some of the projects that we can do with carbon management, we see a lot of inbounds, a lot of unsolicited feedback from the money side. And what we're seeing is, back to Colin's point earlier about money in the sidelines, we see a lot of money getting raised, a lot of funds being put together with ESG mandates, with carbon management specifically as part of one of the projects that they want to invest in, a lot of infrastructure funds. And I think the feedback that we're getting is that it's hard to place that money. And it's hard to place that money because the projects are not advanced, or they don't offer the economic returns that their investors want. So we see that evolving. I mean, we still have a few years before we reach FID, but we see the projects coming together in a way where the money side, the capital side is going to mature in a way where we feel that these projects will have a lot of interest and a lot of really good capital behind it. We also have the DOE has supporting through their loan program a lot of the initiatives. So where we're talking to them, there's now green bonds that you can raise at the corporate level. So we're trying to structure this in an optimal fashion. We're looking at capital raise in a way that provides the best support for the project to be capitalized and get put off the ground. But we're very pleased with how the money is kind of following the right projects, and without us going into a roadshow and going to a financing, all kind of pushing hard to try to get the money. People are coming to us and saying, "We're watching. We like what you're doing. Let us know when you're ready. We'll make sure the money's there."
Is Francisco, is this from here to 2045? I know that's it's kind of a pretty long planning horizon, but I mean, is there going to be a lot of capital involved in what you're describing? Like, is there a way for us who are watching this to understand, what the TerraVault, where the expense is, what kind of expense, how it happens? Can you give us a sense of that? Basically, all the costs that you're layering on to do this, is there a way to understand how big that is?
Yeah, so we've talked about it. We had an update to the market October 6th, our carbon storage update, and we laid out the framework of how we think this is going to play out. We recognize we are going to be a first mover in the California space in terms of carbon storage. And what that means is we're prepared to participate throughout the value chain. So from upstream, which it's the carbon capture in terms of carbon storage, midstream, or downstream, which is our storage tanks in the pore space that we offer. Depending on the emitter, so the first portion of carbon management is going to be point to point. At some point, we'll talk about hubs. We'll talk about a lot of integration, but that's a future stage of the project. Right now, we have to provide validation to the market that this works, and that's going to be from an emitter to our tanks in whatever form that takes and whatever distance that is. So what we're prepared to do is invest in the entire value chain. So that means from the capture facility at the emission source and then transport it and inject it into our tanks. So in that scenario, you get the majority of the incentives at both the federal 45Q and state LCFS. You should be able to retain the majority of those incentives, but you also have to put forth the capital. And that capital, you can see there's a lot of academic papers and people that are looking at the cost aspect of this, but we see that at about a $5 to $20 per ton of cost upfront to be able to put the systems in place. So that's what's going to require capital. Now, we also have the option, or and again, it's dependent on the counterparty, to just be the off-taker of the CO2, which is a little bit more of what a Denver is doing, right? So we have the flexibility and the ability to participate in different ways through the value chain. Now, this will evolve. We'll see exactly where the business takes us, but we're willing to put our balance sheet to work, some of our free cash flow to work in carbon management to unlock the value here and also bridge between where we are today, where we're still putting together the business segment to where the money is ready to invest, right? So we see this evolving. We see a potential capital call on these investments if we participate along the value chain, but we're well positioned to be able to achieve it.
So, guys, when you think about everything you're doing, right, from carbon management and solar, all of these things that will get you to that 2045 net zero, how do you think about capital and returns in general from a sort of philosophical perspective? Does everything you do that you're doing right now, do you look at it and think, okay, this has to be able to return something similar to what our base business is, or is it these things are required for us to actually sustain our traditional oil and gas business? What's the thought process around how you allocate capital to all of these things that you're doing from a decarbonization and net zero perspective?
Yeah, Craig, when we think about it, and I think Francisco just said it right, but just to want to overlay there to Maynard's question, which is, this is billions of dollars of capital across the entire supply chain to be able to offset the multi-billions of dollars of capital. We do think that over time, as you structure these projects, you start to de-risk them. But I think that and so therefore you'll find new sources of capital. You'll bring financing to bear. It's not all CRC equity, for example. That's over time. I think what Francisco said, and just very important, which is based off of the free cash flow that we have from our current set of assets. We have laid out a plan on that October 6th carbon storage update that shows that we will have $2.5 billion over the next 5 years after reinvesting in the base business. And we sort of split that, half for shareholder return, half for targeted, not committed, for carbon management activities. So we have a lot of flexibility. That's over $1 billion that we could put to work. Now, do we anticipate having to do that across all these projects? Not necessarily, but we can. And I think over time, as these projects become more routine, I mean, I know, Craig, being from the ESG side of things, it's sort of like doing wind farm projects back in '99. They weren't defined. And then over time, they became more defined, more de-risked, et cetera. We're at the early days of wind farm development and carbon storage. That's exactly where we find ourselves. And so, but to answer your question specifically, right now we're doing these projects because they're economic and because they fit our unique asset base and leverage our unique set of skills. So when we think about solar, we're looking, for example, front of the meter, we're looking to leverage our surface acreage and where we are, and we filed for interconnection agreements. But we don't think that we're necessarily the best developer for that. We think we can contribute our assets in for a bit of sweat equity. Behind the meter, we're doing because we get the economics of having, not having the wholesale level and the T&D level, the rates that are being charged to produce the hydrocarbons. Plus we get LCFS credits. Okay. Plus we have some net metering. So those are economic projects. We see the same thing with carbon management. As we look at 45Q and LCFS, you can get a return that I'll call adequate, which is not completely defined, but adequate returns for the risk being taken. And we think that it aligns itself with the energy transition. The risk return is there on these carbon projects. And so we're willing to invest in them. Francisco, you want to add anything?
No, I think you covered it, Mac. I think we're seeing the returns from the projects. I think the framework that we laid out is we're going to invest in the core business in oil and gas in first. And the excess free cash flow, we have the flexibility of putting it to work in carbon management. But it is a risk return dynamic because right now we're early, we're seeing really attractive returns in the carbon management sector.
I mean, one thing you said, Francisco, which is really interesting, if you had an oil and gas project that needed billions of dollars of new capital, you'd be worried. When you have a new energy, a new world, climate CO2 driven business that needs billions of dollars, people get excited because they're like, where do you put that money to work? There's a lot of money that would like to go to work in that space. Mac, maybe one question for you. I think we're all, wondering / hoping that the investing world and the rest of the world realizes that classic oil and gas companies are a huge potential part of the solution here because of their skill sets and their thinking and their engineering and their project mindset and everything they bring. Are you noticing investors as you go out on a roadshow or something like that? Are you noticing them, kind of the light going off where they say, aha, this space, these kinds of companies, they're not what I thought they were, or, kind of having that feeling of oil and gas is not dead in 10 years. Oil and gas will be solving the problem in 10 years. Or what would you tell us about some of those early returns?
Well, I think what I tell you is first, investor sentiment and interest in the company, and particularly new investors, is a lot driven by the ESG story or the sustainability carbon story. I think they who are new to the company somewhat look past the oil and gas. But I do think that over time, we need to change the investor sentiment. And I think you saw Finkit come out with a statement from COP26 where he was saying no investment in hydrocarbons. And then he said, well, now we need to work with, the oil and gas producers because they're the ones that can help solve this problem. So I think over time, people are going to start to realize that the infrastructure, the subsurface knowledge, the assets that oil and gas companies have and the ability to sequester carbon is going to rely heavily on those firms. And it is those firms who can find a way to reduce the carbon intensity of their crude that I think will be successful in the long haul. And I'm not suggesting necessarily everybody getting to zero, but there has to be a reduction. There also has to be a reduction of point sources, whether it be things like combined cycles that support the power grid. In California, there was a bill that the governor put forth on energy policy that didn't make it out, didn't get run through committee, et cetera. But it wanted to try to establish something like an LCFS for the sequestration of combined cycles, because people realize that there will be point sources that use hydrocarbons. And so I think there's this balance going on. I think people who have the headlines of we want zero hydrocarbons for 2045, that's fine. But I think the practical reality is it's going to take carbon sequestration to get you to the net zero, not zero production of hydrocarbons.
And is 2045, is that something that the state has tended to talk about, or because I think we were all prepared for 2050, and then you brought it in 5 years? Is there a reason why you chose that particular date?
Yes, because it does. You're right, Maynard. California has said 2045. So when they created the LCFS goal, it was 40% reduction by 2030, and they wanted to get to net negative by 2050. So 45 was zero. That hasn't been put into law or into regulation. It's just the glide path is 40% by 2030. But that's where the bill AB 1395 came forward, and it was pushed as this 2045 net zero and actually putting it into law in California. Why did California choose 2045? Likely to be 5 years ahead of 2050. I mean, it's just to be on the cutting edge, which, quite frankly, if you think about the programs that have been put in place through LCFS, and there was, I should also mention that, and it may have gone under the radar screen, but this year there was a cement bill. Cement is a lot of point source CO2. There was a cement bill that went through in California that's now going to go to the rulemaking process to establish an LCFS-like, and its reduction of 40% by 2035 and zero by 2040. 40% by 2035 and zero by 2045. So California is pretty advanced in the thinking about how to incent the net zero economy, if you will.
Yeah, since I'm the equity strategist, I guess I got to ask you the equity question here. You as well as another company is about the size of you is going down to carbon capture, just energy transition type stuff. And you've already laid out a $250 million share repurchase program. I think you've done $100 million on it. You just initiated a dividend. And you talked about, I think, on your last call about, other options for free cash flow. And I'm just wondering, that sounds great, but how do you balance that with the investors you're looking to attract over the next 2 or 3 years? You've obviously had a lot of high yield guys that become equity holders. At some point, they're going to want to transition out. And how do you just say, you know what, we really don't want to be paying a lot of variable dividends or anything like that. Maybe we want to go ahead and throw it at growth because that's where we're going to have multiple expansions. How do you balance that right now, considering that the technology and all that is coming in the next couple of years? Yeah,
Francisco, why don't you take this? Because I know you've got the flexibility about how we can spend cash up front versus later and sort of manage that over time. But it's a great question, Mike, because it is when you look at balancing the two segments, if you will. We're not spending a lot of money right now on carbon. We're doing early stage development, permitting, business development, legal work, et cetera. And so, but the capital's coming. I mean, that's what, Craig asked the question, the capital's down the path, but it's a matter of timing. And so that's really why we've had a share repurchase program to increase liquidity in our shareholder base, because we came out fairly concentrated. I think we also viewed ourselves as significantly undervalued by basically any metric at the point in time. And now we're continuing to say we're going to, we did extend the share repurchase program because you're right. We did about 104 something through the end of the quarter. And it gives us another quarter of glide path to get to the 250 million, but then put a dividend out there. But I think you're asking a more strategic 5-year type question about the balancing of that. And so, Francisco, you want to take that?
Yeah, and I think you covered it, Max. So we see it through a 5-year planning lens. And the objective in the near term is to be, first of all, we saw a deep discounted stock price that we wanted to go after, a lot of value, and that's why we did the share repurchase program. Now it's a combination of share repurchase program and dividend, and the objective is to lower the concentration of ownership that's a result of the bankruptcy. It's a highly concentrated equity shareholder that some of them are not natural long-term shareholders of the company. So by instituting these shareholder return policies, it attracts new investors to come into the stock. They come in, take a fresh look. That creates the buy and sell opportunity. And we've seen some really good progress in terms of lowering that top 5 investor and start getting into more reasonable levels. That's the first order of business. The capital commitments in carbon management will start coming in years 2, 3, 4, and 5. So this serves but having both options, we're able to do ultimately what we stated that we're going to do to the market is a high portion of our cash flow is going to be returned to shareholders, but we'll invest in carbon management. And as Mac is saying, over 5 years, it's not going to be equally weighted every year. We're going to be, as we're doing right now, putting more forward into the share repurchase program and dividend. And as the options materialize on the capital deployment for our new business, which is carbon management, we'll start stepping into it. So, it's underpinned by a fantastic cash flow generation potential from their underlying oil and gas assets.
I'd also say, Mike, over time, and if you look at the equity and the investors that are coming in at the stage as we deconcentrate and rotate, there's several who have stayed with their positions, coming out of bankruptcy. But if you look at us relative to Brent, we've started to disconnect from trading from Brent too, as we bring in the new investors and have this carbon management segment. And as you know, coming out of 2020 and into 21, the space was, investor sentiment was be very prudent with your capital deployment in the oil and gas business and return it to shareholders. We're doing that. But at the same time, because of the significant cash flow of the low decline asset base that we have the ability then to say, okay, well, we'll reinvest and stabilize at 100,000 barrels a day. And then we'll give half back to investors and rotate the other half. And I think that's been well received. I mean, a lot of people think that investing in this carbon, if you can do it economically, and we're going to, do it prudently, they think that that's a good form of an investment. And so it's a shift in those dollars there. But look, I always say one of the things that we want to do is we're going at it very pragmatically. We're working on permits. We're going to work on sources. We're going to then deploy capital and get to FID and then do the next 10. But that's going to all be based off of the project level economics, our sources of carbon, our incremental sources of capital, working on the project level debt, if we will, or others that have an interest in buying into projects as they get de-risked by the time you get to FID. So I think it's been well received from that perspective, but we're out proving it up every day as we work to get these projects to FID.
Are you, as you do these new things, plan these new things, are you having to go get new and different talent, or what's the HR team side of this, or do you find you can do it with most of your own people?
Well, look, I think we've got a lot of geologists and engineers from a technical capability, and we've actually moved those into a dedicated team with Chris Gould, who we've hired as our Chief Sustainability Officer. We've put, a dozen FTEs into that group, and then we are leveraging Francisco's time, my time, other executives' time, and I would tell you that you probably double that amount of headcount for who are working on it full time. Because of the business development, the aspects of finding, capital, et cetera, that Francisco's working on, all the deal making that's going on. So it's been I guess the short answer, it's a combo. It's a combination of the technical resources and the reservoir engineers and geologists that we have, combined with our business development people that have the skills, but we've had to increase. And so it's one of the things that you'll see going forward. We're going to need to show people, because there's always a focus on G&A, dollars per BOE. And we've done a lot of work on making sure we get those down to levels that we think are appropriate. But as you're adding back G&A, you want to definitely separate those. But again, it is dollars being spent at the early stage development in either headcount, legal, consulting type fees, if you will. But yeah, it's definitely been, we created a dedicated organization to go after this because we see it as a big opportunity.
Well, look, it's fantastic. And I think where we all are in energy land is we're all cheering for each other right now, because what you're doing is going to cast a nice halo on everybody, give us all new good ideas. Mike, I think TPH needs to apply for a Class 6 permit. Can we do that? I'm just making it up. But seriously, Mac and Francisco, as we wrap it up, first of all, a huge thank you for joining us. This is really fascinating. But secondly, any advice you would give other management teams who are thinking, I got to reduce emissions, I got to add a new segment to my business, I've got to attract investors with returns and some new sort of climate sex appeal. What anything you'd pass on to those other management teams watching about how they can better do some of those things?
Well, it'd be a little forward leaning for me to try to understand everybody else's, business and things of that nature. But the one thing that I would say is that, particularly in California, we are at the forefront of the energy transition. And, when you hear, and I agree with what came out of COP26 that we talked about earlier on this call, on this podcast. But what I would say is that while we are in California and it's leading the energy transition, the energy transition is coming over time. That doesn't mean zero hydrocarbons. That just means that we need to figure out a way to work on lowering carbon levels. And it's going to come one way or another. And so adjusting to whatever time frame of that energy transition is. Again, I think it's going to be set at 2045 in California. That's what people should be looking at.
Francisco, anything you would throw in there?
Yeah, in a lot of ways, California is presenting these progressive ideas that the rest of the country is starting to implement, right? So the federal views are morphing or accepting a lot of the California ideas around energy transition. So if you want to take a peek at what the future looks like, look at California, right? So LCFS, greenhouse gas taxes, this very strict regulatory regime. But rather than to think that this is the end of our industry, I think just like we do with, we have decades of doing this as an oil and gas industry, is evolving, adapting, and using our great talents, our great people to be able to make it work. And I think, California TRC is the prime example of that. I think we're going to be okay as an industry.
Well, there's a lot of talk about, why can't the U.S. and India and China just sit down, the three of them, and figure some stuff out? I was thinking we need a Texas-California energy summit. And just, lock the doors, and we'll come up with our own climate plan. Somewhere between the two, I think we'll figure out the answer.
Yeah, I think, Maynard, just to add to that, one thing that, we should say is a bit of a cautionary tale. We see what's going on in Europe right now with the energy crisis. Yeah. And there's a wrong way and a right way to do, without passing judgment, but there's a wrong way and a right way to do energy transition. And that's what we really need to focus on. That's what that Texas-California summit should focus on. I know Colin said earlier, we office in Long Beach, or one of our offices in Long Beach, and we see firsthand maybe the outcome of the supply chain issues that are, because we can look right out the window and see those 100 ships sitting out there. And it's really amazing. So it doesn't matter where you are, supply chain or energy transition, there's a right way and a wrong way to manage things. And we want to help, but we want to get it right at the same time.
Mac, you just gave us the biggest gift, because we're always looking for the subject, what summarizes the discussion. And I think we're going to go with there's a right way and a wrong way to do energy transition. A discussion with Mac McFarland and Francisco Leon at CRC. That's a winner right there.
Well, thank you.
Yeah, thanks so much, guys. Good luck, and we'll look forward to staying in touch on how this whole thing plays out. It's awesome. Thanks, everybody.